How to invest for retirement in Kenya. This is a beginner's guide. This video is going to teach you three things. Number one, what are some of the principles of investing for retirement? Number two, where do you actually invest for retirement? And number three, I'm going to talk about common mistakes to avoid when you are investing for retirement. And a research was done and showed that only less than 20% of people who are planning for retirement actually are actively engaged in research and getting to know what they need to do at what particular point. And a good number of people, they retire while still worrying about bills, school fees, medical costs, or daily expenses. And I'm here to let you know that this can be solved with proper planning. So most Kenyans think that retirement investing is complicated. Some think that it's expensive and it's only reserved for the wealthy. But that is a myth. So in this video, I'll show you a step-by-step on how to invest for retirement in Kenya, including the following. I'll talk about three things as I've mentioned: the principles of investing. Number two, the best places to put your money in. And number three, the traps or the common mistakes that people find themselves in when they're planning for retirement. By the end of it all, you will know exactly how to start, where to put your money, and what mistakes to avoid so that your retirement is truly secure. Part one, principles of investing for retirement. Look at this as guidelines, as rules of the game that enable you to invest well when you are planning for retirement. Principle number one, start with your retirement number. I've always talked about this, that before investing, you need clarity. How much income do you want each month when you retire? And where do you get this number? You get this number from your daily expenses, your monthly expenses. We have got rent, you've got food, you've got shelter, you've got clothing. So if your expenses are maybe 50,000 or 80,000 or 100, multiply that number by 12 so that you can get the annual amount. Then multiply whatever you get annually by 20 or 25 or 30. What number is this? This is the number of years that you projected to live after retirement. So the number that you'll get, and it will be between 18 million to somewhere around 30 million, that is your target goal. So everything else flows and follows from that particular number. So principle number one, start with your retirement number. Principle number two, time is your greatest asset. Compound interest works for you when you start investing earlier. But even if you are starting late, you can still increase the amount of money that you are investing. The only thing that you'll have to use a lot of money for compound interest to work for you. If you start early, then time will compound the money for you. But if you start late, you just have to use a lot of money so that you attain the same levels. So the earlier you start, the less money you need to invest each month. So do not procrastinate. Every month counts. So the moment you watch this video, start. Principle number three, diversification is non-negotiable. They always say that don't put all your eggs in one bucket. So don't stack all your investment funds or vehicles in a single investment. You are always advised to spread across stocks, across bonds, across real estate and retirement funds. You do this so that you reduce the risks, such that in case one avenue fails to perform, the other ones will always perform. So you diversify so that you reduce the risk and at the same time improve long-term returns. Principle number four, the last one, discipline always beats luck. Regular and consistent investing on a monthly basis, no matter how small it is much more powerful than timing the market. Treat investing like paying a bill. You see, the way you pay rent, the way you pay water bills, the way you pay electricity bill. So always treat investing like paying a bill. so that you automate the process and you don't have to rely on willpower for you to invest. So when you make investing automatic, it becomes easier for you because you won't have to be struggling whether should I invest today or should I pay any other bill. Those are the 4 principles of investing. Just a recap. Principle number 1, start with your retirement number. Principle number 2, time is your greatest ally or asset. Number 3, diversification is key. Then number 4, discipline beats luck. Now that you know the principles, the guidelines, the rules of the game, the next question is an obvious one. Where exactly should you invest your money in Kenya to make these principles work? And so in part 2, we are looking at where to invest this retirement, where to invest. Now, I'm not chasing high returns. I've considered a number of factors. I've considered safety, and then I've considered security. I've considered a guarantee that your money, your capital will be preserved. So I've got 5 options. Option number 1, NSSF and private pension. NSSF is the basic safety net. Now, if you combine NSSF with a private pension scheme, you are guaranteed higher growth. Now, you look for schemes that have got low management fees and they have got good historical returns. Option number 2, treasury bonds and bills. Government securities have got 2 advantages, 2 major advantages. Advantage number 1, they've got low risk, and advantage number 2, they offer predictable returns. They may not make you rich fast, but they'll provide stability in your portfolio, and you are always guaranteed that the safety of your investment. Option number 3, the Kenya stock market and ETFs. Investing in Nairobi Securities Exchange, NSE, they say it, the stocks or either ETFs, they can offer higher returns if you are willing to take moderate risks. What you have to focus on is you have to focus on blue chip companies that pay high dividends and have been doing that for a long period of time. This will guarantee you passive income for a long period of time during your retirement era. Option number 4, real estate. When you talk about real estate, you can approach it in 2 ways. We have got an option where you are buying plots and developing. Then you have got the option where you are investing in REITs, real estate investment trust funds. So all of them, they will work for you. So you just have to see which one works better for you. So real estate can be a powerful tool, but if done correctly. Rental income can supplement retirement income, but avoid buying properties that drain cash flow instead of producing it. Don't buy a plot to speculate. One of the most common mistakes that people do is that they buy plots to speculate when they are in retirement. Remember, as I always say, retirement runs on cash flow. So if you lock your money in an asset that doesn't bring you monthly income, you will be most likely be forced to offset, to sell that asset so that you can fund your retirement, because retirement runs on cash flow. Option number 5, diversified investment platforms. And they've got platforms like mutual funds, unit trusts, and other regulated fintech apps. This will allow you to start investing even with small amounts of money. I've got another option. We have money market funds. You can have some money in money market funds for liquidity purposes. But be aware that even the best investments can fail if you fall into these traps. So in the next section, I'm going to talk about the common mistakes that people constantly find themselves into that can kill your retirement portfolio. So these are the common mistakes to avoid. There are 5 mistakes. Mistake number 1, starting late or waiting for the perfect time. Delay destroys compound growth. Delays destroys compound growth because for compound growth to work well, time is a factor. So don't wait for salary increase or any perfect market timing. Anytime you have got an extra amount of money, put it into an happening investment scheme, what it will do is that it will give you the momentum and break the resistance so that you can easily start investing. Mistake number 2, chasing high returns without understanding the risks. People look for the next hottest investment. People look for the next hot stock. People look for the next hot, high paying circles. And this might be tempting. And it's tempting because it's risky and can wipe out years of your savings. So understand risk versus reward anytime you are looking for an investing plan. Schemes or plans that will promise you 20% per month, 20%, 25%, they might sound too good, but they are very risky at the end of the day. Mistake number 3, ignoring inflation and fees. Whoever manages your investment funds, they always charge the fees. So it's always advisable to check the rates at which they are charging. We also have the issue of inflation that silently erodes your returns. So management fees combined with inflation, they can quickly erode your returns if you don't check them well. So check charges on pension funds, on unit trusts, or any platform that you are investing in. Mistake number 4, lack of diversification. Putting all money in a single investment type, like either real estate or a single stock, can lead to disaster. Imagine if you put all your money in a circle and the circle goes under, or if you put all your money in real estate and then it doesn't perform well. It will imply that your portfolio will significantly reduce. So you are always advised to spread your money, to spread your investment across different assets. The reason for doing this is just to make sure that should one asset class, should one investment vehicle not perform well, you are still taken care of with other investments. Mistake number 5, the last one, overlooking emergencies savings. Investing without having an emergency fund can force you to sell at a low value, at a loss during a crisis or during a medical emergency. So always have a buffer, and a buffer in form of an emergency fund, which can be put in a circle, which can be put in a money market fund, so that anytime you want to access it, you can easily access it. Remember, money market funds are liquid, and so that should you want access to that particular amount of money, you can always get that particular money, so that you don't always have to go and sell at a loss or go and use the money that is already giving you returns. So those are the 5 mistakes. So as I conclude, investing for retirement doesn't have to be complicated as people make it to be. So start with the principles that we looked at, then choose the type of investment, and then avoid the traps. Just those are the checkpoints. Start with the principles, choose the right investment vehicle, and then avoid the common mistakes. The earlier you start, the more time your money has got to work for you, the more passive income you can generate, and the closer you are to a worry-free retirement period. Remember, retirement security is not about luck, it's not about even how much money you put there, but you need to have a strategy, and you need to be consistent, and you need the right execution strategy. So start today, follow the rules, and your future self will thank you for this. I've done videos on the same retirement planning, whether you are 5 years into retirement or 10 years into retirement. Check them out, they'll be right here for you to have a look, and I'll see you in the next video.